Okay, in this video, I'm going to cover two concepts that are not talked about enough, and ones that have really helped me interpret the market when the market is in a corrective state. So we'll start with a slide explaining each of them, and while I do that, what I really want you guys to sort of focus on and get good at is why is it that we're looking at this, and sort of the concept first before you dive into uh, some of the, try to make this an indicator or something foolish like that, where that's really not the purpose of what I'm presenting at the moment. So let's dive right into it. I got my Epic pen out right here, and let's discuss these two concepts. So liquidity is on the chart. Liquidity, when we're trading the markets, what happens is there are zones where price will find buyers, right? When price is finding buyers, and there are zones where price will rally up to, and it will find these are prior buyers that are stuck, right? These are prior buyers that were stuck. They held through all this mess, and when price rallies back up, they get hesitant and they're happy. And these prior zones where we saw price failures and price comes up to it, these are called liquidity zones, where there's a lot of overhead supply. There's a lot of overhead supply combined with a lack of buyers. And that lack of buyers usually comes from two things. It comes from the fact that we've rallied up so much, nobody wants to buy it, and the fact that we have these prior buyers that don't have an appetite for buying, they just want to get out, and we see a rollover of price. So liquidity is an area of prior resistance on the chart. It can be a prior neckline or break point on the chart, as I described. There are many different, functions in the market that cause liquidity zones to be created, and price begins to churn, price begins to stall in this area, and we get directional price movement either up from the liquidity area or down from the liquidity area. I really want you guys to focus on the concept. Don't focus too much on how do I make this, how do I set alerts in these areas, or how do I make this automated. This is a concept that's based on interpreting price, which is most important, right? You want to interpret price the right way, and focusing in on psychology of the market. Why is it happening? What's causing it? And how market participants are acting psychologically to create these zones. So I don't want you guys to, again, turn this into indicators and take it that way. The flip side of that the concept is congestion zones. So congestion zones are created, and the best ones, and this is key, the best ones are created when we have a lot of selling in the markets, and then we attempt to do this for a few sessions, and what happens is sellers are exhausted to the downside. There are no new sellers at this point for the price to climb even lower. So what happens is price tends to flatten out and not go anywhere for a few sessions in a row on a closing basis. And what happens eventually is we get short covering rallies out of these, and these are usually intermediate rallies, right back into liquidity zones, which we discussed here. So I hope that sort of makes sense. The best, again, I want to emphasize this, this concept is that the best congestion zones are when we sell off, and then build out this area caused from exhaustion. This is exhaustion of sellers. And I apologize, my pen isn't working too well today, so what I'm writing doesn't really look too good. But it's exhaustion of sellers, and there's a short-term, part price goes sideways. There's short-term slight demand in the market, so buyers trying to pick bottoms. And then when price starts to rally, there's a short covering where folks that shorted from this area tend to cover or this area, and price rides back up to a liquidity zone where, again, the forces that drive liquidity that we discussed just a couple of minutes ago kick in, and the price sort of goes through this liquidity and congestion zone when we're in a correction. This is the key part, when we're in a correction. These zones don't tend to mean anything when we're in an uptrend, trending market, or we're less than 10% off highs. They don't mean much because there's enough liquidity, or there's enough interest, I should say. There's enough interest in the markets on a per price level to keep price up and down enough day to day. Here, when we get into a corrective state, which is greater than 10%, what happens is liquidity is low, but we were looking for that price to sort of go into this exhaustive phase to look for congestion in the markets. So focus on the psychology of what this price action means to interpret it well. Sellers getting exhausted creates congestion zones. Buyers running into a brick wall creates liquidity zones, and it's the prior buyers at those points that sell their stock, and they liquidate their holdings because they are so happy that they get to get out even. So those are the concepts. Now we'll dive into a lot of examples here, and that's really the best way to learn this. It's not for me to sit here and give you exact specific definitions. Again, I want you guys to focus on the psychology of this and how it fits into the market cycle. So now what you'll see up on my screen is a bunch of examples that I have from 2016, 14, 13, 2011, 2010, 2009, that sort of show that I wanted to show you guys, and for you guys to interpret as well. So this is, again, not the best example, but what I do want to point out here is we sell off, right? But within a context of an uptrend, we're on the brink of a definition for correction. So this might not be the best example of congestion, but again, we sell off quite a bit off highs. Prices nose diving and sort of coming in. Price also comes in on this day. We come in, and now we sort of tighten up for a few days where sellers are exhausted. There's really not enough. There's not more that they want to sell for price to keep going lower. What happens is price closes here, here, and here in close proximity to each other after a big down day, and we're 1, 2, 3 days down in the markets, and we find that we're going right back up, and we're rallying out of that congestion zone because there's a lack of sellers right around this point. We'll keep scrolling to the left. I've labeled a bunch of these examples. So this one, what we could do is can go from here and down. So the market was not in a correction, but again, it builds out a congestion zone where we're down 1, 2, 3, and then now sellers are exhausted and price closes in close proximity to each other. And what I want you guys to see is the close here is not close. The close here is not near the close here, but the closes here, here, and here are in close proximity to each other, and the market finds demand, and we rally up and out. So those are examples of congestion zones. Now, another one I want to show you guys is, again, some of you might take this as a holy grail, but there's some art and interpretation to this. So at this point, the market is now 13% off highs. And at this point, the market is off 5% off highs. So the best liquidity zones are in corrections. So price came down and price came down. We built a congestion zone. At this point, we ran into liquidity because this is where the prior sellers, the prior buyers got stuck on this particular day. A break of the support, right? Let me just take all that off. So we break that support area. Anybody that bought above this is now stuck. And when price comes back to this area, which we can call a liquidity area, tends to stall and churn, but then flip right back down. Now, the other part of it is we get close, we're 3 closes together, and then basically the market attempts an intermediate rally that runs into a liquidity zone, and the rally fails, and then the rally also breaks a congestion zone, and we go lower. Now, another, I also want to show that this is not, a holy grail. So 3 consecutive closes closer together. The market tries to rally, but we've just had a break of these levels right here. Market tries to rally, comes back in, goes right through this congestion zone, clean slice, and goes even lower. Finally, when the market hits about 10% and is in a correction right about here, we're coming in hot. Price is selling off, price is selling off, price is selling off. And what happens is right near the bottom of the correction, you get 3 days of tight closes, right? 3 days of tight closes. If you can interpret it on a relative basis, this close is not near this close, and this close is not near this close. So this is where we see distribution. And when we see this final distribution, this close is very near to this close, and this close is also near this close. At this point, we create a congestion zone where sellers are exhausted, buyers are trying to step in, and we get an intermediate market rally out of it. And what happens is the buyers that were stuck right around this area, this is basically our liquidity zone. We see friction around it. Eventually, we gap up above it, build new demand, and try to rally up. We'll keep going with more examples. I have quite a few to get through. So here's another one. So from here, the market goes into correction. Right? The market goes into correction, rallies right back up, comes in, and now we see close, very tight closes, and then rally out of this congestion zone after, basically the market is tired of selling stock, and we see a rally up and out. So again, very similar to these 3 closes as well, which I haven't labeled here. Right? The market is coming in from highs. We enter a correction. And when the market is in correction, we see that the close here is not near the close here, but these 3 closes are near each other. And then the market tries to find demand or a short covering rally from this congestion zone. So again, this is price psychology. There's no what is happening? Where are we in that cycle? We enter a correction for this particular market cycle back in August 2015. A lot of you that would have traded this probably remember it. And this is where we see an exhaustion of sellers in the market, where closes are in close or near each other or close proximity, and then we get a rally up and out of these zones. The price tends to stall right around areas of prior resistance. We get some churn here and we fail, and we try to settle above this liquidity zone. When we don't, come back in, do the same thing here, try to come up with this liquidity zone, and rebuild another congestion zone. And finally, we get up and out. I believe this was the Greece debt crisis, this correction here. So keep going to the left. Very similar here. Again, the market is the best congestion zones are when the market's in a deep corrective state. So this one just about or almost met the definition of being off, 10% off highs. What happens is the market is coming in hot. So the market's coming in hot off of highs. We build one close, second close, and third close in close proximity. You see how this close is not near this close, so you can't call this a congestion zone. And these two closes are together, but we lift off right away. So again, these three particular closes were in close proximity, and we try to rally up and out of it, especially when we're near or at a corrective state in the market. Let's keep going. So this was a beauty back in 2010. So again, the market enters a correction. So at this point, the market is now down 17. So let's place the marker right at about 10%. So 10% or lower, the market is in correction. And what happens is one of the first close, we start getting a couple of, 4 closes in a row together. This basically shows us that sellers are exhausted, and price tries to come up and out and basically runs into this larger liquidity zone that price was stalling at before, right around this area, and come back in to find more exhaustion in sellers. So the final attempt that we had to get out of this correction, we again saw a bunch of closes together. And at this point, again, this is a clue. We remain in a correction, 10% off highs. And price is closing near the prior day's close, and we build a zone, and we see exhaustion and sellers. Price tries to go up right into this liquidity zone, and then we power through and new buyers come in. At the same time, this is what results in an uptrending market. So that is another example of liquidity, congestion. Liquidity, price gets directional at the liquidity zone, and we get into a new uptrend. So there are few more examples that I wanted to show. So this one probably not the best example, but again, the market is in an uptrend, so it's not that meaningful. It's the best congestion zones are when the market is in a corrective state. July 2009 was pretty much the last example that I had right about here. But you can go study history, study corrections, and you'll see the same sort of pattern where once the market gets off highs and we run out of lack of sellers, we try to attempt a rally up into the liquidity zone, and then market tries to find secondary buyers to go up and out of it. So with that, I hope some of this makes sense, right? Again, I want to emphasize, focus on the psychology. The best ones that are congestion zones happen in a correction. I can't emphasize that enough. Don't overlook this, especially in the current market. We're greater than 10%. The best ones, price comes in, we get a lack of sellers. tries to rally up into liquidity zones. At liquidity zones, we get either direction back down or we power through the liquidity zones and start a new uptrend. So with that, I hope if you guys have any questions, leave them down in the comment section of this post. And I'll be more than happy to answer them. And I hope this video was helpful.